Hey option traders, for today's option trading strategy, we're going to take a look at a long straddle idea for a potential breakout in Salesforce. The stock has been in a very tight trading range recently between around $220 and $230 a share. It's been there for the past month. And according to MarketSmith chart analysis, Salesforce has also formed a consolidation base. And a lot of times when a stock goes through a period of price compression like it's been doing, it then experiences a breakout. Now, that could be a bullish breakout or a bearish breakout. We don't exactly know which way it's going to go. But as option traders, we can definitely set up a trade that will profit no matter which way the stock goes. The trade is known as a long straddle. And basically, if the stock does break out up or down, this trade can definitely earn you a nice profit. So to execute the trade, an investor would want to buy one at the money call and one at the money put. Buying at the money options can definitely be more expensive, and also these options will suffer from something called time decay. Long story short, time decay is simply a measure of the rate of decline in the value of an option over time. But weighing all the pros and cons, I definitely think this trade makes sense. So let's go ahead and take a look at Salesforce stock and set up the trade together. So now we're on my Thinkorswim trading dashboard, and I'm going to show you how to set up this trade firsthand. You're going to first want to type in CRM, which is the ticker symbol for Salesforce. And we're going to take a look at options contracts that expire the week of May 21st, 2021, which I have selected here. And also, I always point this out, but this area right here is where you can select your strategy, which makes it easier to set up the trade. So I'm just going to select Straddle right here in this box. Strike prices, as always, are right here in the middle area. And down here, I've got the trade all set up and ready to go. We're going to be buying a 220 call and also buying a 220 put to create the long straddle. With a long straddle, the further out in time the trade is placed, the slower the time decay. But the options are also more expensive that way and will require more of your capital. So for long straddles, it's usually smart to go out about 3 to 4 months and then look to close the trade halfway through if the profit target has not yet been hit. This helps to minimize the time decay, which ultimately gets more severe the closer the trade gets to expiration. Worst case scenario, we'd see Salesforce stock hold a stable price, which over time would cause the call and put to slowly lose value every day. So for a long straddle like this, it's best to cut your losses once you lose around 20% of the initial investment, which in this case would be roughly $780 for this trade. So to recap, this option trade involves buying a May 21st 220 call and a May 21st 220 put. The total cost of the trade would be around $3,800 and the max risk would also be the same. And there you have it. I hope this was a helpful trading strategy. Remember, options are very risky and investors can lose 100% or more of their initial investment. So please make sure you practice with a paper trading account before risking any real money, especially if this is new to you.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.